Emma, today we're going to talk about the world economy, and we can have this first slide up. Maybe not. I'm going to call this 2023 world economy hard landing, soft landing, or no landing, and those are the issues I'd like to talk about. I think there's no question we have a lot of cross currents today blowing through the world economy. One of them is what's going to happen to the U.S. economy. Another issue is what's going to happen to inflation and the Fed. Have they done enough? One thing I want to talk about with you is the globalization business model that we see being increasingly under stress. And I think that has major implications for Australia. And then one more thing I want to talk about is shifting sands in China. And again, a really important factor for the outlook for the Australian economy. So those are some of the topics. If we have the next slide, you'll see my formal agenda. It's basically these items, and then getting to number 5, talking really about what they might mean for Australia and different sectors of the Australian economy. And then finally, a couple of fun thoughts about the effect of aging on economic performance, kind of a secret good news story for Australia. So we'll get to that as well. Let's move on, and let me start by giving a view from the U.S. That's where I am tonight, and that's where I hang out. So I thought I might try to give you a quick update on the U.S. economy. And if we have the next slide, you just see kind of there's a lot of uncertainty in the American economy right now. Many people are like, I think things are pretty good, and then others are like, no, I'm not so sure things are good. Maybe we'll go into recession. So I just would like to make the point that I think it's best to think of the U.S. economy as like 1,000 regional and subsectoral economies. And some of them are expanding and some are not. And let me just give you examples. If you look at just the last 12 months, auto production is up 16%, restaurant sales are up 12%, air travel up 9%. Basically, people are still traveling, they're getting on airplanes, and they're eating out in restaurants. Those things are up. On the other hand, plastic demand is down, residential investment spending is down, home appliances is down. I spoke at the American Home Appliance Manufacturers Association in New Orleans a couple months ago. Pretty depressed lot. In many ways, they're down more like 12 and 15% from market peak, like 16, 18 months ago. So definitely some sectors are doing well, some are not. I think if we have the next slide, I'll just tell you what I think is the most important thing to watch, and that is the U.S. labor market. The U.S. labor market has been really hot. It has been generating millions of jobs a year. We are seeing a cooling down of the labor market, but it is not collapsing. The chart on the left shows monthly employment numbers. This is jobs created in the U.S. It is now running, the last 3 months has been running about 150,000 new jobs a month created. That sounds good, but that's down about half from where it was at the beginning of the year. So we are definitely seeing a cooling in the labor market. And on the right, we have some data. This is the job posting site Indeed. So they post job openings. And we've indexed everything here to what it was just before COVID hit. And what you see is surprisingly lower numbers than you might think for a lot of job categories. Software developers down below, before COVID, human resource officers, marketing, banking, and finance. Many of these sectors are now looking pretty weak. So that is definitely a feature of the U.S. Labor market right now. One thing that is not weak still is personal care, home health workers. These workers are still really hard to hire. So these are where we are still seeing some pretty good job creation. So keep an eye on the labor market. The labor numbers will really, I think as long as the labor market is creating jobs, 100,000, 150,000 jobs a month, we're not going to have a U.S. recession. But if we see continued weakness in the labor market, and if it keeps getting weaker, that does open up the possibility of a U.S. recession. So the second thing to look at is the next slide, and that is consumer spending. And this chart looks complicated, but it's really a fun chart. The top is personal income, and the bottom is consumer spending. And if you look at the left third of this chart, you see what things look like in normal times. Consumption, is growing 4.1, income's 4.2. This was from 2018 to 2020, just before COVID. Everything lined up, everything is logical, and boom, what happened? COVID happened. Look at the purple at the bottom. That is people going in their front door, locking the door, and not coming out for 3 months. That is people not going to restaurants, not getting on an airplane, not going to sporting events, not going to concerts, not going to movies. So that was a lot of pent-up demand. This was foregone consumption or pent-up demand. The really interesting part of the American economy was stimulus checks and about $6 trillion of fiscal spending, $1,200 checks, $1,400 checks, and so on. We estimate that the government put about $3 trillion into people's pockets by spending. Another couple of $1 trillion was put in people's pockets because of pent-up demand. So you can see what's happened now the last couple of years. The money has been pouring out. A lot of that purple at the bottom, which has been exceeding the prior trend, has really been fueling the American economy. Consumers have been spending. They are going on vacations to Europe. They are traveling. They are going to Florida. They are getting on planes and they are traveling. They're eating out in restaurants. That has been sustaining the economy. We are concerned that most of this dry powder is now gone. In fact, we see almost all of the dry powder is now being gone, and that's a concern as we go into the last months of 2023. The next slide shows one more concern that we've got, and that is increasingly American households have been relying on credit cards to keep spending. And many households, they're becoming stressed by higher food prices, higher energy costs, and so on. And we've seen this is the largest increase of consumer credit card debt that we've seen in the last 40 years. So that's a concern. People are continuing to spend, but really by putting a lot on debt. And then the next slide is also a concern to us, and that is by income breakdown. This is University of Michigan data, and we look at the richest 1/3 of families, middle 1/3 of families, and the lowest 1/3 of families. You can see with all those stimulus checks we're hitting in 2020 and 2021, everyone was feeling good. Everyone was doing better than the year before. But you can see we've had a pretty good deterioration the last year. The richest households, the richest 1/3 are still saying we're doing about as well as we were a year ago. But if you look at the bottom 1/3 of households by income breakdown, they're definitely feeling stress. And we are starting to see delinquency rates rising of credit and of car loans and some of those other categories. So we are seeing a pinch in the consumer sector. The next slide is one other concern that we have, and that is the world economy is not going to ride to the rescue of the American economy. The data on the left is PMI manufacturing data. This is for Europe, and you can see a lot of really numbers that don't look very good. A lot below 50. You've all been seeing the German numbers came in extremely low in the data that we just got the other day. And so these data would suggest we actually could be seeing Europe moving into a recessionary cycle. And I think Germany is pretty much there already. So we got to watch that closely. We are also seeing China is slowing, and we are seeing Asian economies also posting lower PMIs. And so we are expecting to see PMIs down in China, in Japan, in Korea, for example, and Australia is going to be affected by this downdraft that we believe we're seeing in Asia. So that's kind of the downside. There's one good piece of upside on the U.S. economy that's creating jobs, and that's the next slide. And that is the stimulus money that we have been pumping into the economy. We have 3 major spending initiatives President Biden has put in place. One is the Investment and Infrastructure Investment Jobs Act. That was $1.2 trillion. We have $370 billion in the Inflation Reduction Act. This is a lot of green energy spending. We have $52 billion in the CHIPS Act, which is subsidizing semiconductor plants. And I'm just going to show you now a set of 5 slides maps that just show dots where some of these plants are being located. These are new EV assembly plants. So these are going between $1 and $2 billion each. Some of them are $3 billion, a lot in Ohio, a lot in Michigan, a lot in Tennessee, Kentucky, Georgia, and so on. Some in Texas. That's a Tesla plant down there. So this money is pouring into the economy, has been helping. The next slide is EV battery plants. So these are the yellow dots. We have been getting a lot of yellow dots. We are basically seeing almost on a weekly basis EV battery assembly plants being announced. Hyundai announced about $4 billion in Georgia a couple weeks ago. A month ago, LG announced a $5 billion EV battery assembly plant in Phoenix, Arizona. So these yellow dots are quite big. These are more like $3 and $4 billion a pop. Next slide is semiconductor plants. So this is another key driver of American growth right now. These are semiconductor plants, many of them fueled by the CHIPS Act. We have two plants. Intel's opening two $10 billion plants in Columbus, Ohio. Micron is opening a plant in upstate New York, more than $20 billion plant. We have a couple of $5 and $10 billion plants being opened in Phoenix, Arizona. So we are seeing a lot of money pouring into these plants. One more slide, please, is something that Australians can appreciate, and that is cheap natural gas being used for LNG and for industrial plants. Look at the coast of Texas and Louisiana. You see a lot of purple dots there. That's the heart of the American energy sector. But interestingly, so some of this is cheap natural gas is going to be driving LNG export facilities. Look up, though, in West Virginia and Pennsylvania. These are fracked natural gas, Marcellus formation natural gas is being fracked. And we're building ethylene crackers and so on in West Virginia. One opened just in the last couple of weeks. And also ethylene crackers are opening in Pennsylvania because of cheap natural gas. So that's helping to drive investment. And one last piece of the story is data centers. Can we have the next slide, please? So this is these are data centers and cloud computing centers. So we are seeing these basically open all over the country. These go for almost $1 billion each, and you can see the black dots or the dark blue dots. But this is quite a bit of investment spending also that is helping to keep the American economy going, at least as we speak now in late 2023. You see a couple of dots there in Washington, D.C., in Northern Virginia. I don't know if people realize it, but 30% of all internet traffic in the world flows within 5 miles of where I'm sitting here. It's this is really the heart of the world. Internet system is flowing through Northern Virginia, so in Washington. Anyway, those are some things that are keeping the American economy's nose above water right now. And so I think what we have to watch is we have to watch the job market, and we have to see whether consumers are tapped out. Those will be big determinants. Let's go on to the next slide. I want to go on to the next topic, and that is inflation. Can we have the next slide, please? Oh, I had one more thing I wanted to share. Yeah, this is, we have here at our firm, Keybridge, we have a recession tracker that we look at 12 indicators to see whether we might be seeing a recession coming. I just wanted you to know we are seeing a lot of red on our page, and so this makes us nervous. It doesn't mean that there's automatically going to be a recession coming, but of our 12 indicators that indicate whether we might be having a recession, 7 now are red. So we would say we're definitely going to be monitoring recession risks pretty closely. In particular, a strike by the United Auto Workers next week, students having to make loan repayments starting again October 1st. These are some of the factors we think could be slowing American consumer spending and the economy as we go into the fourth quarter. So now let's go on to the big issue of inflation. Next slide, please. And the Fed. And this chart is our way of trying to capture what's going on with American inflation. The purple on the dark blue is a measure that we call Keybridge Top 45 to Watch inflation measure. So this is a measure of service sector inflation. You see the components on the left. It is It's your water bill, your sewer bill, insurance, airfares, eating in McDonald's restaurants. It is your telecom bill, your wireless bill, and so on. These numbers are coming down. They have peaked. They are coming down. This data that you're looking at is the last 6 months at an annual rate. So we have seen some moderation of overall inflation. You've all seen that headline inflation, CPI inflation, is down to 3.2%. We don't think we're totally out of the woods yet. And some of this is because we still are seeing some pretty good inflation embedded in the service sector. So we think we've got to keep our eye on inflation. The next slide really shows the Fed's question. This data here is two things. The light blue is the labor turnover rate. These are the number of people who walk in to see their boss on a Tuesday and say, I'm going to quit this job. I'm going to go across the street and get another job. About 3% of all Americans are quitting their job every month until about half a year ago. Now we're down to only about 2.5% of American workers are walking and quitting their job every month. So we've seen some cooling of that. I'm plotting this against the Atlanta Fed's average wage index. And what you see here is wages and the willingness to quit a job correlate really well together. You're seeing that in this chart. We've seen a peaking of the Atlanta Fed's wage measure. That got up to 6.5. It was 5.7 last month. Just today, we got new numbers. It's 5.3 year on year. So the question is this good enough for the Fed to feel that their job is finished? And it's getting closer, but we think the Fed still is not totally convinced that there's no more work to be done. I think they're definitely on a pause in September. They're not going to raise rates in September. But it is definitely possible that we will see one more rate increase in November. So got to stay tuned on this one. The next slide is something the economists are worrying about here in this country, and that is labor market strikes. And I know you've had some issues in Australia, in the LNG sector. In the U.S., we have basically been seeing the most strike activity that we've seen in 20 years right now. We had some teacher strikes in Chicago and so on in 2018 that gave that one blip there in 2018. But we are watching the strike behavior pretty closely. The United Auto Workers are pushing for a 46% increase of wages over the next 3 years. They also want to have their work week cut from 40 hours to 32 hours with no reduction of pay. So you get in a sense that's a pretty aggressive negotiating position for the United Auto Workers. We'll have to see how that plays out. But I think a lot of eyes are watching strike activity and what happens with the United Auto Workers next Friday. That'll be a big day for the fourth quarter and for the inflation picture in the U.S. So one more picture I just want to show on the inflation story is, if we can have the next slide, is Taylor rules. Now, a Taylor rule is simply John Taylor developed this concept, but you basically say, if the Fed were true to its own historical behavior, what interest rate would the Fed set today, given that we have 3.2% inflation and we have 3.8% unemployment? So you can estimate these things historically. And what you see is over 2020, 2021, early 22, you can see why many people said the Fed was behind the curve. They had the interest rate at 0 when the Taylor rules would say they should have been at least 2%. The Fed is catching up. We think they're getting close to terminal rate. So we're at 5.25 to 5.5 right now. With that maybe the peak, if the strike happens and we have a slowdown of the economy in the fourth quarter and maybe even negative GDP, probably the Fed will be done. If we don't have a strike, if the economy keeps going, and we're going to see a good third quarter GDP number, probably 4% range, maybe even 5% range, probably at least 3.5%. That could trigger at least one more Fed rate increase. But at least the Fed is getting close after being behind the curve for much of the last 3 years. Let's go on. I want to go on and talk about the globalization business model next. One more thing. You guys are bankers. We need to talk about banking. The banking sector in the U.S. is now facing some pretty good stresses, and I just wanted to make sure I just want to make sure I put these items in the back of your heads. First, lending standards are tightening. Basically, the senior lending officer survey the Fed does, every bank in America is tightening its credit standards. So that's number one. Number two, we are bracing for a downturn of commercial real estate prices. We think they're going to go down at least 15%. And I think commercial real estate is a big item on the asset side of many banks' balance sheets. So at least a third of assets tend to be commercial real estate for banks. So we think that there's a hit coming from commercial real estate market price declines. And then the last thing is I just wanted to point out banks have basically been paying almost zero for their deposits. Money market accounts are now paying more than 5%, and banks increasingly are going to have to start paying more out for their deposits, going to pay more interest on deposits. The combination of all of these things, we think, is going to put the banking system in the U.S. under stress. Got to keep an eye on it. I'm not worried about the survival of the biggest banks and so on, but I think the overall banking system is going to be feeling some pretty good stress over the next 6 months. Okay, let's go on and talk now about I want to talk about the globalization business model and it being under stress. And just real quick, what do I mean by the globalization business model? Pretty simple. It just means the free flow of goods, services, people, capital, national treatment, profits can come home, and basically production goes to the lowest cost locations. Lots gone to China the last 20 years. Everyone knows that. That's what we're talking about. Let's go on, and I just want to talk about the stresses that are building on the globalization business model. There have been building pressures for 15 years because of lost manufacturing jobs in Europe, in North America, and so on. There's been a growing frustration about non-tariff barriers and subsidies to state-owned enterprises, like in China, for example. I think everyone knows this. COVID was a new factor that actually disrupted the globalization business model more than I think people realize. So first of all, there's the whole question of blame, of who caused the outbreak, and are you sharing full information? You Australians know this really well. Other things that happened, though, were prioritization of national interests. Some countries halted PPE exports. Some countries blocked vaccine exports because they said, force majeure, we need it at home. Again, Australia knows this story very well with some vaccines that were supposed to be exported from Italy to Australia. The big thing, though, has been rising geopolitical tensions, especially the realization that autocracies might put military interests above the economic interests of their people. And I think this has been a really big development. The next slide, I just have a few data points to share with you. I think Mr. Putin's invasion of Ukraine really has upset the apple cart on this front. Basically, if you go back to 2021, just before the invasion of Ukraine, Russia was exporting $87 billion a year of energy to Western Europe. It was exporting $186 billion a year of total exports to Western Europe. And basically, this was almost 20% of Russian household income that was explained just by exports to Western Europe. Mr. Putin's invasion kind of made the point very clear. You could put military goals ahead of the economic well-being of your people. And this really has challenged the idea that globalization will bring world peace. And I just want to point that out. The next slide shows some of the reactions that we're seeing. We are now, many people are applying this message to China or asking questions about what would happen if China would do an invasion of Taiwan. I think we know this is something that's on people's minds. Many firms are moving to what they call a China plus one business model. And what this says is, I'm not going to close my factory in China, but if I need to build a second factory, I'm not going to build it right next to the first one. I may build my second factory in India or Vietnam or Mexico or some other place. And we are seeing that becoming really conventional wisdom over the past year in the business world. Not just American firms, but many firms are now making this be their business pattern. If we see the next page, the next slide, you'll see that we're seeing some changes in composition of U.S. imports. So this is the share of U.S. goods imports by country. I just went back to 2017, compared that to 2022. in 2017, the U.S. got almost 22% of its goods imports from China. Now it's getting 17.8% from China. You look at the share on the right, the share from Vietnam is up sharply, the share from India is up sharply, the share from China is down. So we are starting to see some evolution of global trading patterns because of some of these concerns about this globalization business model. Now, last point I wanted to just make is shifting sands in China. So if we can just have the next slide, just to hold it there for a second, and I just want to talk about some new business challenges. Let's go on, and I just wanted to say, I think many people know that the situation, both the economic and the business situation in China is getting more challenging. If we can have the next slide, please. I think conventional wisdom is, yes, China's going through a growth slowdown, but it's temporary. China's government can use policy to boost the economy. The real estate sector, construction can restart growth. I think that's the conventional wisdom in many places on the economy. And on business, I think the conventional wisdom is, with effort, businesses can accommodate the Communist Party of China. We know they're involved in running businesses, but we think we can remain in political leaders' good graces. Yes, they're going to be, regulatory, administrative hurdles to get over, but the market's so great, we need to do it. And then also another conventional wisdom, I think, is that clashes of values, like, whether you report truthful reporting of economic and financial data, legal issues, human rights, it can kind of be dealt with. And my concern is that maybe views are not shifting rapidly enough in these areas. So the next slide, I just wanted to quickly lay the scene on the growth story first. I think that the growing signs that growth in China is slowing more rapidly than many people realize. And I think that there is a question that's going to increasingly be asked, which is, can China avoid Japanification? By the way, the Financial Times today has a story with this exact title. So I just want to know, we've been talking about this for a while. The Financial Times just did it today. But I ran a research institute in Japan in the early 90s. I watched Japanification happen in real time. What do I mean? I think it means construction sector, real estate decline. I think it means labor force starts shrinking. It means there's deflation spreads, and that makes consumers, want to stop buying cars and appliances and things because the price can be lower 6 months from now. I think it means negative global backlash for heavy support of exports, and I think it means overly heavily government control of investment. In Japan's case, it was MITI that was picking where the credit was going to flow. And this caused the economy to hit a wall. I have some data, I won't walk through it on the bottom, but just showing, I considered 1992 as kind of a critical year for Japan. So up the 5 years before Japan hit a wall in 1992, you see average growth, labor force growth, construction as a sector, a share of GDP, exports as a share of GDP, and so on. You can see what happened the 5 years after the real estate bust. And the most important number is GDP at the top. GDP fell by 2/3. You see the numbers for China on the right, to be determined. Let's go on. Next slide, please. The many indicators that we look at on China, and we are concerned. The data on the left is something we've been looking at a long time, and that is construction as a share of GDP. Developing countries around the world, emerging markets around the world, hit a peak, and then once you hit a peak, it always goes down. China hit its peak in 2014. We do not think that construction and real estate is going to be driving the Chinese economy for the next 5 to 10 years. We think it is peaked. We have almost 90 million empty apartments in China, and so we do not think it's going to be easy to restart real estate as an engine of growth for the Chinese economy. On the right, we have labor market weakness. We have a guy laying flat, a new college graduate laying flat here in the picture, but this is the youth unemployment rate that's now above 20%. And this is the data series the Chinese government stopped publishing because, quite frankly, it's embarrassing. But the lying flat concept is a lot of youth, 22-year-olds coming out of university and are kind of giving up hope on getting a good job that will use their college education. So we have some concerns there. We're seeing exports down pretty sharply. We're seeing FDI going into China almost collapsing. So we have some concerns. Next slide shows two other concerns on China. One is that the state-owned enterprise share of overall investment spending is up sharply. This data goes to 2020, but we know the last couple of years it's been continuing to go up sharply. It's hard to get data on this, but state-owned enterprises were about half of investment spending in 2017. We think that it's now pushing 70%. This is in line with President Xi's political, his goals to have political control of business, and the state-owned enterprise sector is safer from his point of view, and so they are getting the thrust of investment spending in China. If we have the next slide, I just wanted to this is real quick. The view in Washington is changing really fast, and I just have two papers here. One's a book, but one is my 30-year friend Adam Posen has a new paper in Foreign Affairs called "The End of China's Economic Miracle." I mean, this is what we are talking about in Washington these days. Books like these two have both been seminars given in Washington the last 4 weeks. So this, I just wanted to point out, this is a shifting view. And then one more slide is Jake Sullivan. He's President Biden's national security advisor. I went to his talk at the end of April where he laid out a new Washington consensus, a view toward of U.S. view toward China, but also trade policy. This is pretty important to Australia. He talked about the challenges facing the U.S. I won't go through them, but he talked about the goals for a new Washington consensus. He said, U.S. needs to build resilient supply chains. It needs to partner with like-minded companies, and he mentioned for investment and trade, he mentioned G7 countries, Australia, Korea, and so on. An example would be building like a critical minerals club with shared access. This is kind of becoming the view of what Washington wants in terms of trade policy. The bottom, I just have a couple of comments. This is President Biden's statement. He said the U.S. needs to manage trade competition because China uses state money and strategic incentives to manipulate markets. The old view that money can just flow anywhere it needs to, anywhere it wants to, needs to change. And so, and you've heard the quote that came out of this talk, that the U.S. will have a small backyard but high fences. But basically, this new view is that the U.S. will pick some core technologies that have security implications, and we can't have America be threatened by its own technology. And that's kind of the new view. So these all have implications for Australia. So let's go next to the next slide. And just wanted to say these trends, both on security and also on economics, are going to have major implications for Australia. So you all know about the submarine deal. That's very much a part of how the U.S. U.S. is viewing Australia as a full partner in terms of its security of the Asia-Pacific region. The Quad is getting a lot of attention. Australia is a major player there. This is going to be like the new reality of just sort of security issues in Asia. I think we're going to see major shifts coming on the economic side and on the people side that are going to be important in Australia. I think bulk commodities are going to be less important, and I think tech and people are going to be more important. So we have a couple numbers on the next slide. You know this data really well, but we have top exports in the last year, 2021, but iron ore, 22%, coal, 19%, LNG, 12%. You know these numbers. The world is changing. Green tech is becoming important. China's economy is slowing. The market is going to be increasingly for rare earths, for EV battery components, minerals. Australia has great resources in many of these industries. It knows how to process minerals, and there's going to be a lot of processing of these minerals as well that Australia could do. LNG, I think, is going to continue to have a bright future. It's going to be a bridge fuel, but it's going to be a bridge fuel for like the next 30, 40 years. So I think it's still going to be a very key energy source for the world. One other thing I just wanted to remind Australians, like your number 4 export is actually educational services. So when like a Korean student comes to a university in Australia and goes to university, that tuition payment is actually an export of a service. That's like the number 4 Australian export right now. the U.S. is getting tougher to have foreign students come into the U.S., and Australia is a very natural competitor for the U.S. for universities. Canada is also. So I think that's going to be a growth opportunity for Australia to put out the welcome mat for foreign students. Let's go on. Just wanted to end with a bright note on something that is kind of fun. This is the average age of the OECD countries, 38 OECD countries, and we've put them in three groups: the youngest, the oldest, and the middle. And Australia's in the youngest club. Good for you. US is too. A lot of Latin America is. Ireland is, and so on. Israel is. Old. Western Europe is old. Japan is old. So now the question is, does this have consequences for the economy? Next chart says it does. We looked at the average GDP growth in the youngest countries over the period 2010 to 2021. Average GDP growth in the young countries, 3.4%. Average GDP growth in the oldest countries, 1.2%. Wow, 3 times higher in the younger countries. What about stock market performance? Same thing. Next slide, please. Oldest countries have the lowest stock market performance, 106% over this period. The average age in those countries is 41 years. Average age in the youngest countries, including Australia, is 31.9. Average stock market performance, 148%. So having a young country is good for economic growth and for stock market performance. We've also replicated that for the 50 US states, and the results match that perfectly. So young states grow faster than older states. Young states have faster labor force growth than older states. Last slide is just some key takeaways, and I am winding up, and I hope we can have some questions, Emma, and let's leave this on the screen for a minute or two, but just a few key summary points. I'm sure I've said some things you disagree with, or you want to clarify or give a different point of view on, and so I'm all ears. So fire away, Emma.
Stop presenting. Well, thank you very much, Rob, for that very insightful talk. We've always known that Australia was the lucky country. It's also nice to know we're the young country as well. Just jumping off that, though, we've been known to be the lucky country because of our mineral deposits, our abundant mineral deposits. In your talk, you were a little pessimistic about the long-term future of iron ore and coal. What about the role that Indonesia, India, and the African countries can play in terms of perhaps they may be able to take off in the coming years and offer some demand for some of these core Australian exports?
Yeah, absolutely. There's going to be growth in the world. There are always more emerging market countries, and you mentioned some of them. They will provide. We are going to need to build infrastructure and buildings and highways and rail lines and so on in many of the countries you mentioned. That will provide some new and ongoing demand for steel, iron ore, and so on. China was a unique case, though. It was fast, and it was organized, and it was compact demand. That was like, send as many ships of iron ore as you can get. And I think many of these others are going to be more spread out, and I believe that it's going to be a more challenging environment. It's not going to be the same speed and pace of demand from these other markets.
Thank you. That's really interesting. What about LNG and the future for LNG? You made some brief remarks, but you said it's a transition fuel. It will be in demand for the next 30 years or so. From here, we're seeing quite a bit of inertia from a consumer use perspective. People love their gas hot water and their gas stoves. What's the future of LNG?
Yeah, it's basically pretty bright. And we're seeing it. I mean, in some ways, America and Australia are a little bit competitors, but really in different markets on LNG. But I thought just a couple of years ago, the U.S. was putting 3% of its natural gas into LNG exports. I thought, I hadn't even looked at the numbers. I kind of took, for like a year, I took my eye off the ball. And I thought, oh, someone said, what is it now? I said, I don't know. It's probably 3. Has it gone to 6? I don't know. And I looked and it's over 10. So more than 10% of all U.S. natural gas is now being liquefied and exported, a lot of it to Western Europe. And a lot of it really helped hugely during the Russian gas cutoff, last winter, for example. It is a good fuel, and it has America has a lot of it, and Australia has a lot of it. And yes, you have to compress it, and yes, it adds a lot to the cost, the delivered cost. I think it's going to continue to be a really important fuel, and not just. I think it's going to have a much longer lifespan, I believe, than oil even. And so, yeah, I think it's still going to be a major sector. Yeah, absolutely. I'm bullish on natural gas and LNG. Europe natural markets are going to be India and Indonesia and some of these other places. A lot of it will go to China. A lot of it will go to any place that's burning coal is going to be reducing their coal and converting over to LNG. So that's the way it's going to work. And that's just it's the green push is going to be making coal go down and gas go up.
Thank you. We've got a question from Graham who said you've had a little bit of discussion about the federal deficit, but he was interested in your further thoughts on the deficit.
Yeah. So we have a net debt to GDP ratio that was 37% when I turned out the lights at the White House in 2001. And it's now 100%. It was 75 on the just before COVID hit. And so we went from 37 to 75. So we basically doubled the net debt to GDP ratio from 2001 to 2019, and COVID and the $6 trillion spending just blew the lid off the net debt to GDP number. So we're now at 100%, and the projections are we'll go to 112 and 115, over the next 12 years. It is a problem. It's like termites in the walls of your house. It doesn't cause the house to fall down immediately, but it kind of undermines the whole edifice. And I am concerned that we still haven't got real fiscal discipline mindset of either the Republicans or the Democrats in the Congress. And that is the main reason. Fitch has just downgraded U.S. debt about a month ago. The concern was just Republicans and Democrats do not play nicely in the Congress. And so Republicans want to cut taxes a lot, and Democrats want to ramp up spending a lot, but no one is taking the other half of the story and putting them together so that you have a fiscally responsible path. And I think that we can be looking at over time. We know what's going to happen. We're going to gradually have higher real interest rates than we otherwise would. We're going to gradually have less capital formation than we otherwise would. We're going to gradually have lower productivity growth than we otherwise would. And so that's the problem. And I think Fitch just quite bluntly was correct to point out that we do have this political dysfunction now.
Moving on to a slightly different topic. Over the last, 12 months or so, the Australian government has moved quite swiftly to developing its own green architecture, if you like, to move the economy towards a more decarbonised stance and accelerate that conversion that obviously needs to happen. On your side of the fence, America, as you mentioned, America has put significant financial resources behind its green energy push and initiatives. So there might be some American friends, perhaps even Australians, who might be worried that they could be cut out of some of these spending plans. And, what is the Biden administration's position on these concerns? Is it aware? How is it looking to draw in its friends? I know you talked about the value chain, but perhaps you can expand a bit more on that.
Yeah, it is a concern. some of the EVs, like right now you can get a $7,500 tax credit if you buy an EV. By the way, I personally am on my fourth EV. So, I mean, they've been around a while. They're not new and they work. And I have solar panels on my roof and I have for 13 years. I've driven around the world 6 times on the sun on my roof, solar panels into my electric cars, and I've driven the equivalent of 6 times around the earth at a lower cost than the standard issue of the electric utility here in Washington, and at a lower cost for a vehicle than a Honda Accord. So, the microeconomics actually works quite well for my family. But you can get a $7,500 tax rate. If you're above a certain income category, you do not get it. But the question is, can a Korean battery qualify? Could these minerals, do they have to come from a country that U.S. has a free trade agreement with, and so on? Australia needs to be in the closest American ally category camp. Okay, so Canada and Australia are about as good friends as America has. And should be. And I believe that there's going to be a little fighting here and there about qualifying these minerals and certifying them and whatever. But I think Australia, your diplomats need to be fighting for coverage, and I think you will get it. And the Biden administration knows that security issues go together with economic issues. And quite frankly, it's going to be the same with Korea and Japan and with Australia, but I believe we are not going to have America as friends not being able to make cars or make batteries that can be sold in the American market or get the subsidies that the U.S. domestic companies get. But you got to be vigilant, and you got to push. You got to, your diplomats are going to have to push for it, and this is what APEC meetings and summits and all that are for: is telling the president directly, you got to make sure we're included. I'm excited. I've been reading about green hydrogen in Australia. There's some neat things going on, and that you can't just be copying the technology. We need your scientists and your engineers to be coming up with some new ways of making like green hydrogen or whatever. I mean, I think there's a demonstration plant south of Sydney somewhere that I've been reading about. That, I mean, this is going to be the future, and you should have a big piece of it.
Thanks, Rob. Just off the back of that, do you have any views on the CBAM, Europe's CBAM, the Carbon Border Adjustment Mechanism?
Yeah, so that's we actually we've been advising the state of California for like 12 years since they put in their Assembly Bill 32. They've started a cap and trade system, and the a carbon tax or border adjustment mechanism was actually something we at our firm at Keybridge, helped to kind of design and think about why it would make sense. And you can start to see, if you don't have some mechanism like that, you can see why you could be you could get abused. I think there is going to be they're difficult to implement, and there's a lot of negotiation and everything, but there needs to be some enforcement mechanism, or else you really could have the lowest common denominator in terms of environmental standards just flood the world with their products. So it's a way of protecting, and the critical thing is we need a critical mass. It can't just be one country. It has to be the US and Europe and countries like Australia coming together and coming up with standards and common expectations. So, but I think there are you can't have, you'd have abuse all over the world if you did not have some mechanism to allow for an adjustment of price.
Just second last question, and this one is US based. So the US Commerce Secretary Gina Raimondo was recently in China and said that American businesses were increasingly viewing China as uninvestable. Is this really a prevalent view in America now?
Yeah, so good question. I was a little surprised she used that term in China, quite frankly, but It is, it's a pretty clear word. Everyone on this call, bankers on this call know what that word means. And it is, there are concerns that we're not, if you're not playing by normal market rules, that someone's going to get shut out or could have a bunch of investment invalidated. I will just say, like, just in the last 24 hours, 48 hours, Apple, has been told by the Chinese government that Chinese government officials cannot use an Apple iPhone. And, Apple's lost $200 billion of market cap in the last 48 hours. That's an example of, that's not the entire uninvestable story all by itself and everything, but that's if you can wipe out $200 billion of market cap in 48 hours by just making an announcement, those are the kinds of things that do send a fear through boardrooms of people who are thinking about a big FDI investment like in China. Let me just give a couple numbers. Like 2 years ago, U.S. firms did $100 billion of FDI inflow into China. I can't tell you the exact number, but it's like, I saw it on a chart. It's like under $5 billion the last 6 months. It's almost gone to zero. So if you've gone from 100 billion of FDI money from America to China to 5 billion in 2 years, that's not a healthy trend. So I think that there are many firms that are worried, like, if I make this investment, am I going to be able to get my profits out? Can I send my executive team in to manage the new plant, and will they not be arrested on the street? Will my company executives not have their offices raided, or will they not be thrown in jail on a back tax charge or something like that? So one thing everyone does need to know, American State Department has 4 classifications for security, for do not travel, for going to a dangerous country. And Sudan and places like that have, Iran would have 4. China was a 2. About 3 weeks ago, the U.S. State Department raised the score on China from a 2 to a 3. So it's not like a Sudan, but it's basically saying to business people, we do not recommend you travel to this country. There can be willful detentions of executives on streets can be picked up. So those are the kinds of things that worry companies who are considering a $1 billion investment in a plant in China.
Thank you. That was really, really insightful, especially that analysis on Apple. Do you think you can give me a 30-second response on this last question? And I have to ask it. Donald Trump, could he be president again in 2024?
Oh, man. We could talk 3 hours about that. Unfortunately, from my point of view, it is possible. The latest polls show him tied 46-46 with Biden. That's a new Wall Street Journal poll yesterday. The man is, he's got 4 criminal charges against him in 4 different courts, and so that could change the dynamic. But it is a complicated story. It's not that people don't like Biden; they just think he's looking too old, is one of the key things. And it's still possible Biden could step down. It could be an open primary for the Democratic nomination. So the situation is still fluid. I'll just give you one. I worked for Bill Clinton, and I'll just tell you one thing. Bill Clinton was the governor of Arkansas, and he wasn't running for president. He just decided to run for president in January of 1992, just before he was elected in November 92. So it's now August. That means that someone could enter the race even in January out of nowhere and could be elected president. So I put that out there. So it is a dynamic, it's a fluid situation. And Trump has a really hardcore of support of people who are lower educated, not university educated, feeling nationalistic, and it is a pretty strong hold he has on a group of people.
Thank you. Well, Rob, I just want to thank you for such an insightful presentation today. That brings us to the end of our first inaugural economics webinar series, and you have the honour of being our first. So thank you so very much for your generous time, and thank you for your team as well at Keybridge for all the work that they've put into getting us here today. Your presentation on the global economic context and your generous responses we're very thankful for. As you've said, Australia is a small, open nation, and we're an open economy, and so we are highly influenced by everything that goes on in the global economy, including what happens in the United States. And so we thank you for expounding on that. I also
You're welcome.
thank
thanks for the great questions. They were fun.
You're welcome. I also want to thank our colleagues at the Australian Business Economists for their support today and bringing this webinar to you today. Colleagues from the banking sector, just a small teaser now for our next webinar in the economic series. It will be held in November at a date to be determined, but it will be in early November, and it will involve a significant book launch on global economics. So I can't wait to bring you that one. And we will provide further details to you in the next few weeks. I'm also very pleased to announce a second webinar series where we will be bringing discussions on the future of banking developments, and the first of that series will commence in October. Finally, you will shortly receive a survey that we hope you will take time to complete. It's really important to us, and it will enable us to plan the 2024 economic series in a thoughtful way that you'll be very keen to come along to. Rob, thank you so very much. Lauren in the background, thank you so very much. Wishing you all a wonderful day, a good night to our colleagues in the United States. Until next time, folks, bye for now.
Thank you. Bye.